Welcome to this new regular feature, Bull versus Bear, which we're proudly producing with Cazenove Capital. In this regular feature, we'll bring you an analysis of a leading stock, presenting both a positive and negative case for investment. Today, I'm joined by George Ward and Lucie Hughes from Cazenove Capital, who are both specialise in direct equity strategies for high net worth clients and families. Today, they're going to give us an insight into how they research investment ideas using Walt Disney as a case study. Over to Lucie.
Brilliant. Thanks so much, David, for the introduction. So at Cazenove, when we're looking to invest in a company, one of our investment process is to do a bull bear, where one person will look at the reasons to invest in the company and another person will look at the reasons not to invest in the company. And we then present this to our direct equity committee, and we have a debate on whether it should be added to client portfolios. And so, as David said, we're going to have a look at Disney today to see what our thoughts are around this. And we thought it'd be an interesting company to look at, as everyone knows Disney. And it's a company that we actually added to portfolios back in November after a challenging year, given the severe impact the pandemic had on some of its business segments. I'm also just going to highlight from a compliance perspective that this is for illustration purposes only, and not a recommendation to sell or buy the company. And just before we start, we're just going to keep it very high level and hopefully draw out some interesting themes for everyone to think about, but not get too bogged down in the technical or balance sheets and income statements. So hopefully it'll keep you interested throughout. So to start with, I'm just going to give an overview of Disney. And as I'm sure when you hear the word Disney, our minds all jump to different memories and experiences that we've had in the past. And it's a really diversified family entertainment and media company that can be broken down into three different segments. So the first one is the Disney Parks. And this is the global hub which aims to bring Disney stories and characters to life. And they do that through the theme parks, resorts, cruises, and also consumer products like toys or books and video games. The second one is the media and entertainment segment, and this includes the much talked about Disney Plus, as well as its other streaming services such as ESPN Plus and Hulu. And it also encompasses their media distribution and advertising sales. The third part of the business is then the content group, and they're focused on developing and producing original content. So this will include popular entertainment such as Pixar movies, as well as news and sports-related content. So hopefully that's given you a bit of an overview of the different business segments that are encompassed within Disney. And I'm now going to hand over to George, who's going to give the bull case.
Yes, I'm going to present the bull case for Disney and why we think it might make a good investment for our clients. And then I'll hand back to Lucie, who will present the bear case, because it's essential that we consider all of the risks before investing in any company. So what are the key strengths of Disney? Well, first and foremost is the brand. Every person listening to this conversation will know this company. Not only, however, is it well recognised around the world, but it is loved around the world. Management estimate that they have 1 billion consumers of their products and services who identify themselves as fans of the brand. And according to IG Group, it is the 10th most recognised brand in the world. We grow up watching Snow White, Finding Nemo and Spider-Man. We then watch The Simpsons in the evenings after school. We made our parents spend a fortune taking us to Disneyland. And then when we reached university, we forked out more money to watch ESPN Sports during our weekends. Eventually, we leave home and we begin this cycle all over again with our own families. A 97-year-old brand is very difficult to measure with such reach across various age groups and demographics, but it's certainly of enormous value. This brand has given it a boost against competitors in the streaming market. For example, we don't go to Netflix World or Amazon Prime Land. So Disney is able to offer a variety of content for consumers to engage with. Furthermore, a quick glance at the bar chart on the right here, and you can see how this brand is spread amongst multiple business segments. As investors, we love businesses with a diverse range of revenue sources. It means that when you get unforeseen circumstances like a global pandemic last year, you've got different parts of a business that can still carry on performing well. So when the parks were closed, we all had more time to spend at home paying for Disney's TV. This leads nicely onto the core of the investment case for Disney today, and that is the streaming app Disney+. In recent years, Disney had been coming under pressure from investors about its future. Netflix was delivering huge growth and spending a fortune on new content, which presented a threat to Disney's cable TV presence, as well as the movie production that it sent to cinemas. Where many legacy media companies have failed to respond, however, Disney's been on the front foot and it's launched a rival to Netflix in the form of Disney+, which includes the full Disney library, as well as content from Pixar, Marvel, Star Wars, and even National Geographic. The Disney+ app was launched internationally in March last year, which some of you will remember as being the peak of the pandemic. And it was actually quite a helpful coincidence, as we were all forced home and their target market was quite literally sent home from school, locked inside with not much to do but watch Disney TV. So it's fair to say, as you can see on the charts here, that their subscription numbers have smashed expectations and it's closing down quickly on Netflix. However, some have questioned whether the platform has the content to rival Amazon Prime or Netflix. How many times can you watch The Lion King or Frozen after all? But what many haven't realised that there are, in addition to these animated classics, live action films, the entire Pixar library, Star Wars, the Marvel superhero movies, there's 250 hours of National Geographic content, and the entire Simpsons streaming catalogue. That suggests to me that there is plenty to keep viewers happy for now. But in addition to this, Marvel is set to ramp up content this year and is topping off 2021 with a third season of The Mandalorian and several other Star Wars series to look forward to in December. Can this challenge Netflix? Well, a glance to the right-hand side and you will see on the slide that The Mandalorian is ahead of some of the big Netflix names in Google searches, which suggests to me that it can more than compete on content. And in case you're not swayed by the promise of even more Star Wars, well, feast your eyes on the pipeline here. Where do I begin? There's a host of content from all the content groups, including Pixar and Marvel. Even National Geographic has Secrets of the Whales, which in my opinion is worth a monthly sub alone. This new content, along with an entire armoury of the classics, means Disney can control its content spend and therefore its profit margins in a way that is likely to be far more of a challenge for much more recent rivals like Netflix. So it's clear that Disney Plus will provide a lot of content to challenge Netflix, but there is a second route to its challenge as well. Hulu and ESPN Plus are launched in North America and deliver alternative content to a wider market, which includes live sports. For example, Monday Night Football in the States brings in 12 million viewers a week, which is a market that Netflix has yet to even enter. However, the acquisition of Fox in 2019 came with what I think is a secret weapon for Disney, because they acquired Star India, which owns Hotstar, which is the leading streaming provider in India, a country with 1.4 billion people and all potential consumers of Disney. They're currently only on 30 million subscribers there, but if you look at how much more popular they are than Netflix, they're off to a great start. And clearly this is a market that can continue to grow in the years ahead. In all of our portfolios, we want to make sure we're invested in companies that benefit from future trends. And this exposure to the world's most populous country as it grows its middle class is essential for the decades ahead and definitely boosts the investment case for Disney. Finally, you can't discuss investing in Disney without considering its famous parks. We millennials and our Generation Z friends, unlike previous generations, crave experiences over material possessions. So statistically, we're more likely to be found in Disneyland than at home saving up for a washing machine or a lawnmower, perhaps like our parents were around our age. So Disney's parks are likely to remain popular for many years to come, and encouragingly, the company has plenty of space to continue to expand them. However, from an investment point of view, a significant move occurred in 2015 when Disney began to move towards more demand-based pricing, which essentially meant raising prices during peak holiday seasons, and this has greatly improved profits and margins. The chart here on the right shows how Disney has been able to raise prices well ahead of inflation, which is the green line, over the last 50 years. This implies that they've made good investments in quality, and of course, this will have provided good returns for investors. Some are questioning, however, whether COVID will provide a challenge to this business model. Will people be happy to go into parks with huge amounts of people enclosed in enclosed spaces? Well, I would point out the reopening of Shanghai Disneyland in May last year, where tickets sold out within 3 minutes of reopening, and these were at normal prices. So that suggests to me that the demand's going to be all right. I'm aware that we said we didn't want to get too technical, but I thought it would be interesting to delve a little bit deeper and look at some of the fundamental analysis that we do on each stock that we research. So with every company we invest in, we consider it against our core 4 metrics. And in the top left here, you can see the operating profits of Disney. This is a great way of assessing a company's market strength. As you can see, Disney has been growing its margins since the 2008 recession. And these consistent operating margins show that it has a strong market position with high barriers to entry, so the business model looks secure. You might notice the dip in the last couple of years. Clearly, last year was a bit of a one-off year, but 2019 included the expensive takeover of 20th Century Fox, which again was kind of a one-off. Looking at the operating cash flow divided by profits on the right-hand side here, this is the second metric we consider. Ultimately, is the company funding itself with cash, or is it regularly having to borrow more money to fund its business growth? As you can see here, Disney has been positive on the cash flow, which is the type of business that we want to make sure we're invested in, and isn't having to risk its business model should cash flows dry up. How strong are the returns on invested capital? This is the next chart. Is it spending wisely? And is this improving over time? Well, categorically, yes, it was, until again, COVID last year, which I think, as from an investment point of view, we can look beyond. The launch of a subscription model in Disney Plus is something that is encouraging for us as investors, because this type of platform model, similar to Amazon and Google, gives the company great scale and requires fewer fixed costs as they expand, so that this would be strengthening margins in the long run as well. Finally, we would look at dividend management, not a huge part of the investment case for Disney, but we're encouraged to see that they've been growing the dividend over the last 10 years, and it shows that they have good discipline with their capital. What I thought it would then be interesting is to look at how these charts compare for Netflix, so you can see how we can use these charts to really highlight the differences in companies. And I won't go through all of them here, but you can see on the left-hand side that the returns for Netflix have been far lumpier. And if you look on the right-hand side, you can see that the biggest red flag for us would be the amount of negative cash flow they had, particularly from 2015 to 2019. Whilst this has turned out to be a successful investment, this type of business model is extremely risky and one that we typically try and avoid for our clients. Had there been a recession and people being forced to cancel Netflix subscriptions, it could have seriously put the entire company at threat, and the share price could have suffered enormously as a result. Finally, in any company we invest in, we want to make sure that we have considered how it relates to all of its stakeholders, not just its shareholders. So we consider, for example, how a company interacts with its suppliers, its employees, society, and the environment, just to name a few. We want to ensure that a company is well placed to face the challenges of the future, such as climate change or threats from regulatory bodies. In Disney's case, the company scores highly across a range of areas. We were particularly impressed last year by its response to the pandemic, where it donated funds to local communities near its parks, and it's even provided location for a vaccine centre this year. It also scores well on diversity statistics, and it's committed to competitive pay. It's also industry leading with a target of net zero on emissions by 2030. And to show it's serious about meeting this goal, it's even built its own solar canopy in Paris. So in conclusion, I would say the company is a fantastic brand, loved across the world. It's well run, scores impressively across a range of sustainability metrics. And it's now in a new phase of growth with Disney Plus leading the way. And of course, it's got more support from the reopening of parks as we come out of the pandemic in the next couple of years. So at this point, I'll hand over to Lucie, who is going to try and bring me back down to earth and prevent some of the challenges to the investment case.
So I'm firstly going to start with what happens if COVID stays around for longer than we expect. This could continue to damage the parks, which is a significant part of Disney's business. Parks usually account for around 30% of their revenue, and COVID actually caused the longest closure to the parks in the company's history. Prior to this, they'd only been closed for 2 consecutive days after a hurricane in 2017. The main impact of the park closures was a huge hit to the operating income, and this was hit just under 7 billion, which you can see on the chart on the right-hand side. So not only did Disney lose the revenue from the theme park admissions, they also missed out on all the merchandise, the food and drinks that people buy when they go to the parks, and the resort and vacation bookings. So it really is a serious problem for Disney. Some of the parks have now reopened, which is a positive. But what the problem is that they're running at significantly reduced capacity. So, for example, Disney World is only operating at 35% capacity. And we really have no idea when all the parks will be able to run at full capacity again. And this clearly has a negative impact for Disney. I think the other thing worth highlighting here is that they get lots of visits from international tourists. And this is actually likely to see a longer recovery, and a full recovery in international attendance in these parks isn't expected until at least 2023. So the parks may actually trail a broader economic recovery. People may point to the successful vaccination programs that are in place, particularly in the UK and the US, as a way for parks to be back at full capacity in the near future. However, there are concerns that in some countries, the uptake of the vaccine won't be as high, and this could delay the recovery. So what I've shown on this slide is that people in a survey were asked if they'd get a vaccine if one was available to them. And what you can see is France is in the bottom row, where only 40% of people agreed that they would get one. In terms of what this means for Disney, they've got Disneyland Paris, which does remain shut, and it may have to stay closed for longer or operate at a lower capacity for a longer period of time than expected, which really could dent Disney's revenues. I'm now going to move on to a slightly different tack and have a look at Disney Plus. And clearly, as George has spoken about, there's been a lot of excitement around Disney Plus as it was recently launched. But what I'm going to highlight is that it doesn't have anywhere near as many movies or TV shows as Netflix. So it's going to have to spend a huge amount on content in order to rival competitors. You can see that last year, Disney spent around 2 billion on Disney Plus content. And they've also updated their guidance for 2024, where they've said they're going to spend around 8 to 9 billion on content. And this has doubled from original expectations back in 2019. So whilst this is a huge increase, it is still dwarfed by Netflix, who are planning on spending 17 billion on its content this year alone. So for now, Disney can rely on its rich content libraries like Marvel and Star Wars, but fresh content will be needed to keep that engine running. And therefore, growth at Disney actually will be quite reliant on aggressively deploying capital into new content. The chart on the right, that shows the rapid adoption of Disney Plus in 2020. And in a positive story, the number of Disney subscribers across all its streaming services is expected to overtake Netflix in the next few years. However, management have actually left their profitability guidance unchanged since 2019 and only expects to achieve profitability for Disney Plus in 2024. When investors look at tech companies, whether that's Facebook or Google, the crucial metric that we look at is the average revenue per user, which you can see on the slide, ARPU. And this is measured by dividing revenue by the number of users, and it effectively shows how companies monetize their users. And you can see from the table at the bottom there that Netflix still holds the lead, generating around $11 per user versus Disney Plus at only $4 per user. Finally, whilst there is a lot of talk around Disney Plus, it still remains a pretty small part of Disney's overall business. So some may question whether this will have much of an impact on its overall revenues. So a trend that we have been seeing in recent years is a secular decline in linear or cable TV, as people now consume media in different ways. And I've just put two charts here to highlight this, and it's showing that firstly, we're spending a lot less time watching TV. So this is almost halved in the US. And also the chart on the right, young people aren't using cable TV anymore as a way to watch TV. Only 37% of 18 to 34-year-olds subscribe to cable TV. So you might be thinking, what does this mean for Disney? And linear networks account for 45% of revenues for Disney, and they earn both affiliate revenues as well as advertising revenue. And so this trend could actually negatively impact this legacy media part of the business. Disney's seen a slowdown in its media networks division, and an example here would be ESPN, which is their cable sports channel, which has lost more than 11 million subscribers over the past 6 years due to the emergence of alternative viewing platforms. So George has highlighted some of the really exciting areas of growth for Disney, and I've highlighted some of the potential risks to the company. And our job now is to decide whether we think, firstly, it's a good company, but even more importantly, to decide whether we think it would be a good investment. And just because it might be a great company doesn't necessarily mean it would be a great investment for our clients. So one of the questions we may consider is, has all the good news been priced in? And what you can see on this slide is that the chart on the left shows Disney's share price in blue versus the biggest 500 companies in the US in pink. And over the last 6 months, Disney's share price has increased 55%, reaching an all-time high in March. And this was driven by the strong performance in Disney Plus, as well as expectations that the parks are going to start to reopen. So we might argue actually that all the money's been made here, and we should think about taking some profits and moving into other investments. The chart on the right shows the valuation of the company, and the PE ratio is a key way to assess how cheap or expensive a company is. And what this ratio looks at is the share price divided by its earnings. And ultimately, what this tells us is how much you're paying for every dollar of profit that the company makes. And you can see that last year, the share price rose quicker than its earnings and has subsequently become more expensive. So the PE is currently around 50, whereas on average over the last 3 years, it's been about 25. So it's significantly more expensive than it usually would be. And the company's earnings will need to recover quickly from the pandemic to support such an optimistic valuation. So overall, it is looking very expensive. So I'm now just going to summarise my bear case in 3 points. So firstly, capacity at the parks is significantly down, and this could persist for several years. My second point is Disney Plus, one of the main growth engines for the company, has an inferior average revenue per user to Netflix, one of its main competitors in the TV space. And thirdly, the company is really expensive. It's performed very well already, and perhaps it's best to look elsewhere. So that draws an end to this mini bull bear, and hopefully you found some interesting snippets to think about, and given you a bit of an insight into what we look at when looking for new investment ideas. So I'm now going to hand back to David for a few questions.
Well, thanks very much, George and Lucy, for that very interesting overview. Question for George first. I mean, Lucy highlighted that Disney is planning to spend $8 to $9 billion on content in 2024. But Netflix is spending $17 billion this year. So do you think that Disney has underestimated the amount it's going to need to spend on content in coming years? Does it have the will, the firepower to really compete with a firm like Netflix on the creation of content?
Yeah, I think it's interesting, the difference between these two figures. Netflix clearly expects to outspend Disney significantly, even in 4 years' time. I think that my point on this would be that Disney has an enormous library of content, of almost timeless classics for children and adults that Netflix hasn't really been able to build up in the same way. So we've seen in recent years, as Prime and now Disney Plus has begun to challenge Netflix in the streaming space, Netflix really trying to create products that forces people to not want to move elsewhere. So we've seen Stranger Things and The Crown in particular be real success stories for Netflix. And I think they're going to have to continue to spend a significant amount to continue to try and build up this library of content that can match Disney. But what we've seen is the sheer amount of content that Disney already has means I think they're under less pressure to spend quite as much as Netflix to build this up, because they've already got, as I say, such a wide library there already.
So Netflix and others playing catch up, and Disney monetizing that library of what they've got already and freshening it up as they need to with the spend that they're planning.
Exactly, yeah. Disney has content for children, for adults, and it's, as I say, it's films, it's TV, it's animated things. It's such a wide variety, whereas Netflix isn't quite competing in all of these spaces yet. So I think they've got to still build up that library of content to make sure that their current subscribers don't get twitchy fingers and look elsewhere.
Okay, well, thank you for that. A question for Lucie. Disney's brand is something that's completely global, iconic, part of our lives as children growing up, and then as adults with your own children. And can you really, question the value of that brand, the success of the company with a brand of such intrinsic value?
Yeah, I think you're absolutely right. It clearly is such an iconic brand, and it really is a fantastic brand. And it's gone from strength to strength. It's been able to pivot to different streaming services. And it has been a really good investment for us and performed very strongly. But I think what I'm concerned about is that this is actually already reflected in the share price. Investors are aware of the value of the brand, and actually we've seen a real recovery in that share price. So, I've highlighted some of the risks that could come along for Disney, and, we may see a correction. So given that it's currently trading at 50 times earnings, I'm not sure that I would be wanting to buy at that level. It does seem extremely expensive, and perhaps all the that value of the brand's already been priced in.
Okay, very interesting. Thank you. And finally, a question for you both. On the corporate social responsibility side, Disney scored negatively on supply chain labour standards. I know that Cazenove particularly looks very carefully at sustainability in investing. So how do you reconcile that? I mean, George, in the bull case, how do you reconcile this negative score with the positive case to invest?
Yeah, I mean, as I said, it scores pretty highly across a range of metrics, but it does, on the MSCI ranking that we included on the slide, it does have a slight negative figure for the supply. And I think part of that is almost just the raw data. It's how MSCI grades it. It has a lot of its supply comes from developing countries where they don't quite have the same standards, perhaps in those countries as we do in the more developed world. But what we point out is that Disney has its pretty rigorous standards of its own that it sets its suppliers by. And so we're sort of contented by that, but it's something that we would continue to watch and make sure we wouldn't want to see that go in the wrong direction. Okay, thanks. And Lucie, what's your perspective on that?
Yeah, I think what's really important to highlight is when we're doing bull bears, sustainability is one of those things which we encompass as part of it. And so, as you said there was a slight negative, and we look at that risk as part of the investment and take that into consideration when making the investment. But actually, as George said, for Disney, it actually does score very highly across all metrics. And they've got a specific code of conduct for their manufacturers. But something that we would want to do is continually to monitor that. And if there was a point where we saw that slip, we would really want to engage with the company and question them on this and see what they're doing to make improvements. So in terms of it being part of a bear case, I probably wouldn't be too concerned at this point, but it is something that we would want to monitor going forwards.
Okay, thank you. Well, thank you for joining me today on the first Bull Bear. We hope to bring you more analysis in this way in the coming months ahead. So thank you both for joining me.